look at the hot inflation numbers and the hot GDP numbers in the years following the end of World War II. For World War II, we borrowed aggressively to fight a visible enemy. During COVID, we borrowed aggressively to fight an invisible enemy. So when you shut down the world for a month, you have to stimulate and you have to borrow and you have to do those things to give people money when they're not allowed to work. You just can't shut people down and not give them money to live. And that's exactly what they did. So we had to fight this invisible enemy. And it's not dissimilar from an economic standpoint. I'm not equating COVID to World War II. But look, a lot of lives were lost and an enemy had to be defeated. And with record-breaking vaccines and all the other things that were done, and stimulus and backstopping the corporate credit market, et cetera, et cetera, et cetera, they were able to do that. But it cost money, and what we're paying for it now, we're paying for it with short-term transitory inflation. Some will be durable inflation, like wages, maybe some aspects of rents, and that's why I think we're going to run 3 to 5% above trend. This 2% thing, I don't know they'll walk back the rhetoric or not and manage expectations to 3 to 5. I think they want to keep expectations pinned at 2, even though the game plan is 3 to 5. So look at the inflation rate. Truman ended World War II in 1945. In 1946, inflation was 18.1. So we basically had that the first year out of COVID, that 9% inflation. The next year, it dropped in half to 8.8. The year after that, it dropped to 3. So we're probably going to go, from 9 to 4.5 to 3.5, and then maybe stay in that range for another few years. So it went 18 to 8 to 3. Then it went negative the fourth year. So that was probably some aspect of deflation in 1949. Then it bounced right back above trend to 5.9 to 6.0, and then it normalized at less than 1%.